Hello and welcome to session 4 in our basic group accounting course. We are going to start looking at some little complications in relation to group accounting. We know how to prepare a basic statement of financial position. We know how to prepare a basic statement of profit or loss. Now we need to think, well, what is going to come up when we're doing that might complicate matters? The first thing that we might see is post-acquisition profit. So what we're going to do is I will explain it to you here, and then I'll remind you how to prepare a statement of financial position, and you can have a go at the example, and then I'll work my way through it and show you what you should have done. So post-acquisition profit. This is profit that is earned by the subsidiary, and it's been earned by the subsidiary from the acquisition date up to the year end that we're working towards. Okay, post-acquisition profit of the subsidiary. Where are we going to work it out? Well, we're going to work it out in our working 2. Remember, we've got 5 main workings. Working 2 is the equity table in order to work out the net assets of the subsidiary. And once we work out the post-acquisition profit, we are going to share it out, because remember, the NCI is going to get some of it, their percentage, and the parent is going to get some of it, their percentage. So if the NCI was, let's say, 20%, the NCI is going to get 20% of the post-acquisition profit, and the parent then would get the other 80%. Okay, so how do we work it out? Well, we do our usual working 2. We start with the year-end share capital and accumulated profit. We then work our way, same as we did before. Share capital stays the same at the acquisition date. We usually get the acquisition date retained earnings or accumulated profits in the question, except this time we are going to get the movement. Okay, so the movement is the final column here, over here. The movement, well, if you had accumulated profits of, let's say, 100 at the acquisition date, and then by the year end they were 150, the movement would be the post-acquisition profit. And remember, that's what we're looking for. We are looking for the post-acquisition profit. We will then give the NCI their percentage of the post-acquisition profit in working 4, and we'll give the parent their percentage of the post-acquisition profit in working 5. So we calculate it in working 2, and then we share it out in workings 4 and 5. As per usual, easiest thing to do on this is an example. So we're going to look at illustration 4. I have a pro forma ready to go in the Excel workbook. We're looking at Evan and Dando. Just to remind you, so looking at illustration 4 in the Excel workbook here, remember we need our workings. Working 1 is the group structure. Working 2 is the one I've just mentioned, so do it in the way that I've said. Working 3 is the goodwill. Remember, you'll take the acquisition date net assets from the equity table and put them in here. Working 4 is the NCI. This time we'll have the NCI at the acquisition date, but we'll also have their share of the post-acquisition profit from working 2. That's the movement that I talked about here. The retained earnings will be the same. We've got the parent's retained earnings, then the share of the movement from here. Okay, and that will enable you to do the usual statement of financial position, adding across and bringing the figures in from your workings. Now, feel free to pause the video now and have a go. Just do your best, see how much of that you can get, and then I'll work through it bit by bit with you, and we'll see where you went right and where you went wrong. But do pause the video now and have a go. So hopefully you've had a go at this. Let's see what we should have done, starting with working one, the group structure. The year-end date, so it is 31st of December X5. We acquired them 1 year ago, and we had an acquisition of 150 shares, of which there are 200. So that means we've got year-end date 31st of December X5. Then we've got the date acquired 1 year ago. Now that means they're going to have earned some post-acquisition profit. The parent NCI is 150 out of 200, so that's 75%, and then the NCI is going to be 25%. The amount paid, always worth noting, was investment in Dando, 500. There it is, up at the top. Okay. Always set out a group structure, because that means you understand what's happened when, and it feeds into the rest of the workings. Next working then is the equity table. So I said start at the year end. So we've got 200 and 100 by the year end. The share capital then always stays the same, 200. And the retained earnings at the acquisition date, well, it tells us in the notes that they were 40. So we can immediately see that there's a movement between here and here, 40 to 100. That is going to be 60. So movement between here and here is post-acquisition profit of 60, which means we have net assets at the acquisition date of 240, at the year-end date of 300, and movement or post-acquisition profit of 60, which we're then going to use later on. So that's working 2, our equity table. The next working is working 3, our goodwill. Now most of this we've now got in our previous workings. The cost of investment we always write down in working 1, so that's 500. The fair value of the NCI at acquisition, well, that will generally be given to us in the notes. Later on in the course we'll see how to work it out if they don't give it to us, but in this case the NCI on the acquisition date was 100. Less the net assets at acquisition, which always come from working 2 column 1, means that we have goodwill on the acquisition date of 360. So goodwill is 360, and now we just need our NCI. So again, remember, start with the amount we used in the goodwill working. Now this is where we need to do a little bit of a calculation. The post-acquisition profit from working 2 was 60. The NCI percentage was 25%. So it's going to be 25% of 60. So that equals 60 times 0.25, which is 15, which means the NCI at the year end is 115. Okay, so they have the value at the acquisition date, but then we gave them some of the profit. So that means by the year end, it's gone up. The retained earnings, well, the statement of financial position for the parent tells us that there were accumulated profits or retained earnings of 250. And then we give them their share of the post-acquisition. So that's 75% of the 60. So that is 60 times 0.75, which gives us 45. Add that up and we get 295. So that's our 5 workings, same standard workings. This time though, we had some post-acquisition profit to bring in. And we can now then pull everything together. So the goodwill we take from working 3, there it is. We can add across the assets. So we'll add across the parent and the subsidiary. Parents shares only, which are 200. Accumulated profit, 295 from working 5. NCI, 115 from working 4. Add across the liabilities. And hopefully when we add this all up, it will add up and balance. So all of this comes to 1410, and all of this also comes to 1410. So there we have it, a statement of financial position, including some post-acquisition profit. So again, this is good practice to pull together our statement of financial position to understand where it all fits, with a particular focus on post-acquisition profit. We'll then go on in future sessions to look at other little bits and pieces that can complicate matters when we're preparing our group accounts.